gold is crushing equities, plain and simple. The metal blasted from roughly $2,392 an ounce last summer to about $3,338 in the first days of July 2025, a jump of roughly 40% in 12 months, and about 25% just since January, a pace that leaves every major equity index trailing in the dust. The drivers stack up almost too neatly. Global inflation remains sticky despite headline moderation, wage pressures linger, energy markets keep flaring on every geopolitical twitch, and real rates, though higher than in the free money days, hover at levels that barely dent gold's inflation-adjusted appeal. Add relentless geopolitical risk. Ukraine's grinding stalemate, uncertainty around Taiwan, the Middle East's stop-start ceasefires, and the psychological bid for a hard physical store of value refuels itself day after day. Central banks keep filling their vaults, led by China, India, and several Gulf states, further draining available supply in the open market and turning every shallow correction into an excuse for sovereign accumulation. Investors fleeing equity volatility have essentially decided the simplest hedge is to buy the shiny yellow insurance policy that never defaults, never dilutes, and never issues profit warnings, whatever corporate earnings season may dish out. Fortune's early July market wrap captured the mood perfectly by noting that even formerly skeptical hedge funds have capitulated to the rally, tacking bullion onto portfolios once dominated by tech growth names. Momentum bleeds straight into miners. Coeur mining surged nearly 40% in a single 30-day stretch by leveraging operational gearing to the rising metal price. SSR mining printed a mid-teens return over the same span, and AngloGold Ashanti added almost 13%, each piggybacking on widening margins as revenue per ounce outran energy and labor costs. Exchange-traded funds like VanEck Gold Miners amplify the move by bundling producers, explorers, and royalty plays into one ticker, an approach that retail investors appear to love because they sidestep single-asset hiccups such as unexpected pitwall failures or political coups in producing nations. The key point: miners historically behave like leveraged versions of gold, rising faster in bull phases and collapsing harder in busts, so the current outperformance fits that script. Yet, signals are mixed. The technical DASCAD gold price forecast flagged early July weakness in miners versus spot, a divergence that often precedes broader pullbacks. Translation: enthusiasm is sky high, but discipline is still compulsory. Zoom out and the macro underpinnings remain supportive. Federal Reserve commentary keeps toggling between cautious optimism and acute nerves, with policymakers stressing data dependence while markets sniff out lingering rate cut hopes. The yield curve refuses to normalize, flashing inverted warnings that recession chatter refuses to die. Fiscal wrangling in Washington drags on, deficit projections expand by the quarter, and a possible change in fiscal guard post-election injects yet another layer of uncertainty. Investors recall the trade war volatility under the previous Trump term, and note that a fresh round of tariff threats could reignite cost-push inflation, derail fragile supply chain healing, and once again reward the asset that thrives on distrust in paper promises. Meanwhile, Europe struggles with structural energy dependency, Japan watches the yen slip toward levels unseen in decades, and emerging markets juggle debt burdens swollen by a strong dollar era that looks set to persist until the Fed decisively pivots, and outcome officials refuse to timetable. Gold feeds on this global cocktail of rolling stress points, acting as the only asset class that every region instinctively buys when local variables turn hostile. Price mechanics echo prior supercycles, successive record highs fuel media coverage, drawing fresh retail demand in a feedback loop. Exchange-traded product inflows spiked in March, then plateaued, suggesting institutions rotated early while late. Cycle buyers now chase. COMEX positioning reveals large spec net longs near multi-year peaks, yet commercial hedgers still show no sign of panic, implying mining companies feel comfortable locking in supply at these elevated quotes. Physical premiums in key Asian hubs widened through the spring, especially in Shanghai and Mumbai, proof that real-world demand is not merely a Western paper phenomenon. Wholesale bar shortages forced refiners to scramble for scrap supply, driving local cash prices several percent above international benchmarks. That disconnect matters. When physical tightness collides with leveraged futures, squeezes can erupt sharply, extending rallies beyond what macro variables alone justify. Still, cautions multiply. Technical analysts observe negative divergences on daily momentum oscillators. Brett indicators falter among small-cap miners, and the ratio of silver to gold flips in a pattern historically seen near cycle peaks. Silver outpacing gold can mean industrial optimism, yet when the surge stems from safe haven spillover, the move sometimes flags frothy sentiment rather than sustainable demand. Furthermore, implied volatility in gold options, though elevated, has not exploded, hinting that professional money smells risk but sees no capitulation. That complacency could crack if hot inflation prints force the Fed to shelve rate cut dreams deeper into 2026, boosting real yields and handing algorithmic sellers a cue to dump metals. The last time real rates shot up in late 2021, gold recoiled nearly $200 in weeks. Bulls argue structural deficits, war-driven fiscal taps, and political gridlock will cap any real rate jump, but history shows nothing moves in a straight line. Investment vehicles span the spectrum. Physical bullion bars remain the purest play, yet demand secure storage and insurance, costs often overlooked by newcomers rushing in after viral TikTok clips praising gold's forever asset aura. Minted coins carry collectible premiums that widen when supply is thin. American Eagles, Maple Leafs, and Krugerrands frequently trade several percentage points over spot, eroding break-even thresholds for impatient buyers. Exchange-traded funds backed by allocated bullion, notably the SPDR Gold Shares behemoth, trade like any stock but impose annual expense ratios that compound over time and expose holders to tracking error if redemption demand surges faster than authorized participants can source metal. Closed-end trusts like Sprots offer optionality on narrowing discounts, although liquidity is lower. Futures deliver precision on leverage and expiry, but require margin discipline that many retail traders underestimate. A 3% adverse move can wipe an unhedged position. Options allow defined risk but price in volatility, so wrong way theta decay punishes the casual speculator. Mining equities and royalty streaming companies deliver torque plus corporate-specific risk, operational mishaps, country expropriation, labor strikes, and ESG crackdowns. Some miners hedge production forward, capping upside, while royalty firms skim top-line revenue with minimal operating exposure, appealing for conservative portfolios yet lacking explosive upside if gold gaps above 4,000. Portfolio construction matters. Traditional 60-40 stock bond mixes bled simultaneously in the inflation scare of 2022, teaching investors that correlation assumptions can flip quickly. Adding even 5 to 10% gold would have slashed that drawdown, a fact now plastered across brokerage marketing decks. Academic backtesting from the World Gold Council shows that over half a century, a low single-digit allocation improves Sharpe ratios, regardless of whether the investor hails from the United States, Europe, or Asia. Critics argue gold's lack of yield drags performance when growth and real returns are healthy, but supporters counter that the opportunity cost of zero yield evaporates once inflation wipes out real deposit rates. Indeed, Treasury inflation-protected securities did cushion portfolios, yet they rely on the integrity of government CPI calculations and still face mark-to-market pain when nominal yields spike, a fate that gold sidesteps. Sentiment is split along ideological lines, too. Hard money advocates tout gold as insurance against currency debasement fueled by deficit spending schemes, whether pandemic relief or tax cuts skewed toward high earners. Progressives defend fiscal stimulus aimed at green infrastructure and social safety nets, yet admit that financing via bond issuance at still historically low yields raises sustainability questions. The prior administration's corporate tax cuts punched a temporary sugar high into equity markets, but ballooned deficits with no offset, demonstrating how both partisan camps stretch fiscal orthodoxy when convenient. Gold remains agnostic, rallying on any signal that real purchasing power of paper assets might erode no matter whose signature adorns the Treasury Secretary's desk. Market structure evolutions also support higher plateaus. Basel III banking rules assign zero risk weight to physical gold versus higher weights to paper derivatives, incentivizing bullion holdings within certain capital requirements. Digital tokenization of gold bars on blockchain rails promises lower friction for micro-allocations, opening the floodgates to millions of small investors in regions with capital control barriers. Sovereign wealth funds and oil-exporting nations quietly rotate windfall petrodollars into bullion, following lessons from the 2008 crisis when overexposure to Western bank equities cratered their books. Meanwhile, the green transition paradoxically helps gold massive battery and solar deployments intensify demand for silver and copper, pushing miners to discover multi-metal deposits where gold appears as a byproduct, thereby tightening dedicated gold supply. Risk factors cannot be glossed over. A decisive peace framework in Eastern Europe could slice the geopolitical premium embedded in the metal. A parabolic rally in artificial intelligence stocks might reopen the fear of missing out that funnels cash back into equities. Accelerated decarbonization breakthroughs that crash energy prices would relieve CPI angst. Even successful central bank digital currencies could, in theory, restore faith in fiat at the expense of gold's alternative money narrative. On the supply side, a handful of mega projects such as Barrick Newmont's Nevada Gold Mines or Salobo III in Brazil could ramp faster than expected, boosting annual global output and tempering price hikes. Technology also chips away. Laboratory catalysts trimming the gold content in semiconductor bonding could shave industrial demand. Yet historically, mine supply trends year over year in low single-digit percentages, whereas shifts in investment flows swing double digits in weeks, making supply shocks less influential than sentiment gyrations. For trading strategy, seasoned professionals adopt a barbell, core physical or ETF holding for long-term insurance, satellite tactical trades through options, or leveraged miners. The current environment argues for phased entry rather than lump sum chasing, given overbought oscillators. trail stops under prior breakout levels, such as 3,100, defend profits without second-guessing every intraday downtick. For miners, examine all-in sustaining cost. Companies under $1,200 per ounce break-even enjoy thick margins, whereas high-cost operators risk negative cash flow if gold merely consolidates. Scrutinize jurisdiction politics, tailings dam liabilities, and hedging books before extrapolating headline leverage. ETFs reduce single-name blowups, yet internal weights can concentrate risk in the top 5 holdings, so review index methodology. Tax nuances matter. In the United States, physical gold and most gold-backed ETFs classify as collectibles, incurring a long-term capital gains rate up to 28%, notably above the standard 15 or 20% for equities depending on income. Mining stocks follow regular equity taxation, a detail that sometimes tips the scale for high-bracket investors. Retirement accounts like IRAs shelter gains but come with custodial hurdles for storing physical metal. Abroad, value-added tax applies in segments of Europe to some bar sizes, eroding margins, while Singapore, Hong Kong, and Dubai offer tax-free bullion hubs. Looking ahead, scenario mapping helps. Base case, slow disinflation, muddling growth, Fed cuts begin cautiously in late 2025, real yields slip, dollar grinds sideways, gold edges to the 3,500 zone. Bull case, sticky inflation sparks stagflation narratives, policy gridlock grows, geopolitical flare-ups intensify. Central banks accelerate diversification from dollar reserves, gold pierces 4,000 before year-end, and miners rip higher. Bear case, inflation collapses, productivity rebounds on AI adoption, peace deals trim risk premiums, Fed stays patient, real yields rise meaningfully, gold retraces toward 2,800, miners underperform but multi-year structural floor holds above prior highs. Debate over whether crypto threatens gold continues. Bitcoin's digital scarcity appeals to a younger cohort, yet the brutal downdraft after the 2022 DeFi meltdown reminded investors that code-based scarcity does not equal centuries-tested store of value status. Some funds now hold both, arguing the pair hedge distinct tail risks, gold against systemic political collapse, crypto against monetary censorship. Yet gold's physicality keeps it in central bank vaults, a privilege no private digital token commands, anchoring its strategic demand. Token enthusiasts claim generational wealth transfer will cap gold demand, but survey data shows millennials still buy jewelry and appreciate tangible assets when fear surges. On regulation, ESG scrutiny forces miners to decarbonize, adopt dry stack tailings, and secure indigenous consent, raising capex and extending project timelines. That tightened supply, ironically bullish for the metal even as environmental advocates seek minimal ecological harm. Shareholders push companies to boost dividends and buybacks rather than reckless expansion, constraining output growth. These capital discipline norms mirror the shale oil pivot after years of value destruction, suggesting sustained gold supply deficits even if demand cools. Finally, key perspective, gold is not a magic bullet. It hedges certain risks, not all. It underperforms in flourishing growth regimes with benign inflation. But in the present climate-sticky prices, fractured geopolitics, polarized politics, and potential policy missteps, the case for some allocation remains compelling. If data surprises to the upside, tilt back toward cyclicals. If chaos reigns, let gold cushion the blow. Either way, staying nimble, diversified, and aware of tax, liquidity, and operational risks beats dogmatic allegiance. Markets punish complacency, reward preparation, and gold, for thousands of years, has serviced the prepared.